Chapter 11, Part 2. We're going to look at depreciation under the International Standard versus GAAP and disposition of assets and also component depreciation. Kind of give you an idea of all that now. Under U.S. GAAP, component depreciation is allowed, but we seldom use it, although personally I think it's a better way of doing it. But it's required under the international standard if an element has a significant cost in relation to the total. Now, depreciable base is determined by subtracting estimated residual value from costs, and usually once it's established, or in most cases we don't even have residual value, that's it. But under the international standard, they expect you to reassess that residual value every year. Now, depreciation methods, we have many. Under the international, they tend to focus on 3: straight line, units of production, and diminishing balance. Depreciation under GAAP versus the international standard. Under GAAP, we depreciate each item in total, even if there's various components, but under the international requirement, we have to break it down. And I think a good example would be a building. So let's go through an example. Okay, we have a building. It costs $10,500,000 with a 10-year service life and $500 in salvage value. The building includes carpeting with a value of $100,000, which is a 5-year life and no salvage value, and a heating and air conditioning system with a $210,000 7-year value with no salvage value. What is the depreciation for year 1 and 2 under GAAP and under the international standard, assuming straight line? Well, first of all, we need to know what it cost. We need to know the salvage value. We need to know its service life. We need to know when we bought it. We need to know the components, since we're going to be looking at the international standard, and we need to know the life of each one of those components. So let's first do it under GAAP. That's easy. Year 1, we're going to take the 10 million minus the salvage value divided by 10 years times 6/12, since we bought it in the middle of the year, gives us 500,000. Now let's look at year 2. Now we're going to get a whole year. Now, under the international standard, we're going to have a different service life for each one of our items, so we have to first allocate the costs. And now we're going to have to determine the depreciation for each one of those components. So we're going to get a half a year for the building, the carpeting, and the heating and air conditioning system for year 1. And for year 2, we're going to get a whole year for all of those. Now remember, component depreciation is allowable under GAAP, but we don't usually use it. Now what about disposition of assets? We get rid of them. Well, we start with the selling price. We take the net book value, subtract it from that, and that will determine whether we have a gain or loss. So in this example, we have a truck and it uses units of activity and its mileage. In this particular case, we have the actual mileage. So the first thing we want to do is determine what is our cost per unit, which is $1. So we take the 126,000 minus the residual value divided by the total units. Then we're going to add up all the units to date times the $1 tells us that to date we've depreciated 63,000. Now remember, with units of production or activity, it doesn't matter when you bought it, because you would have used it less if you bought it later in the year. So we ignore that. Now our formula is going to be the selling price, again, consideration, less the net book value tells us we had a loss of 5,000. So this is what our journal entry would look like. Now, what if we'd sold it for 80,000? Well, we'd record the cash, take the accumulated depreciation off the books, take the old equipment off the books, and we have a gain. And that concludes this presentation.